economics, green finance, and economics of supply and demand. A very apt topic for with the changing environment and the path we are in India want to take. To be able to meet our growing demands, we will need to look beyond hydrocarbons and what is needed to set the stage. Today's topics cover these main themes of how we go beyond hydrocarbons and what does India need to do for its demands. With this, I'd like to welcome the first speaker on stage. Can we have Mr. Achal Kad from ABS, please?
Thank you for the warm welcome, Ms. Mandira and Mr. Rajesh. And also thank you to the IEW organizers for giving ABS the opportunity to present as well as to share the stage with esteemed colleagues. I'm Achal Kad. I'm a sustainability specialist at American Bureau of Shipping. And today I'm going to primarily talk about hydrogen and the maritime industry. Before we commence, I would like to share a bit about American Bureau of Shipping for those who are not aware. American Bureau of Shipping is a non-profit marine classification society whose members are owners, operators, designers, builders of ships, vessels, as well as offshore units. There are no owners or shareholders at ABS. The board of members are elected from its members. ABS as a class society represents the industry and helps in design, construction, and operational maintenance. We're headquartered in Houston, Texas, and we have globally about 4,000 employees and 200 offices in 70 countries. ABS's primary mission is to serve the public interest as well as the needs of our members and clients by promoting the security of life, property, and preserving the natural environment. Hydrogen's global footprint is gaining attention as a promising green energy carrier. The world has witnessed a significant increase in announced and planned hydrogen strategies. This is being seen as development of hydrogen hubs in the US, in Europe, as well as in the UK, as well as national announced policies all across the globe in Australia, India, and other regions of the world. So at the moment, the investments are made towards build-up and startup of hydrogen production. Against this backdrop, the maritime industry is uniquely positioned to support the scaling of the hydrogen economy. Using the maritime nexus as a connective infrastructure for the hydrogen economy capitalizes on the ability to move massive amounts of hydrogen across large distances that run essentially on these fuels, and shipping routes can be easily built and quite flexibly when compared to highway transportation and pipelines. However, hydrogen also has its challenges to the maritime industry. Hydrogen's characteristics, specifically as a small molecule and low condensation rate, which is about minus 273 degrees centigrade, poses a technical challenge. To reach this low temperature, high amounts of energy is required for liquefaction. Hydrogen also has a wide flammability range, ranging from about 4 to 75% by air volume. Due to this, a lot of fire safety protocols have to be followed. And when hydrogen leaks in open areas, it is expected to dissipate quickly. However, in condensed spaces, there's a high chance of fire hazard due to quick formation of flammable gas mixture. Additionally, what we've seen is due to the small size of hydrogen, the gas is capable of dispersion through materials, including permeating into the walls of containment systems in which they are stored. Certain metallic materials and equipment that are exposed to the hydrogen gas can suffer from hydrogen embrittlement. These include tank interiors, surfaces, pipes, fuel nozzles, pressure relief valves, and pipes. So the essential practice to avoid hydrogen embrittlement include utilizing proper metallic materials with appropriate thickness, surface treatments, coating films, and to protect hydrogen contact. So far, what we've seen is it's essentially aluminum alloys and stainless steel that have come about as promising options, but various feasibility studies are being conducted by ABS and other partners to determine which would be the best ways to move about the construction. Moving on, ABS as a global organization, how are we enabling this transition to the hydrogen economy? So ABS is at the forefront to enable adoption of hydrogen in the maritime sector. We are the first in the industry to release liquefied hydrogen carrier rules, and we've also released recently a white paper on hydrogen and marine fuels. Moving on to the projects that ABS is involved in, there are a lot of encouraging projects within the maritime sector that are enabling the move to the hydrogen industry. So recently we had a project with approval in principle with Provaris for their innovative compressed hydrogen technology. We recently also signed a memorandum of understanding with Korean hydrogen industry to essentially develop cutting-edge hydrogen-fueled vessels. ABS also issued approval in principles for offshore hydrogen ammonia production platform for Curso. And then we've also worked with GEV's Handymax hydrogen carrier. Domestically, within the US, we recently worked with the UCSD Scripps Institution of Oceanography, where they were one of the first to build a vessel to ABS class specifications and standards. Additionally to all these projects, what we're doing, we're also road mapping to de-risk hydrogen. What does this involve? This involves essentially who are the stakeholders evaluating the design and operations, what is the proposed operations they are considering, major milestones, targets for them, and where is this being proposed? Essentially also looking at why is this transition to hydrogen economy being proposed and how the risks associated with design and operations proposed to be evaluated. Recently, we're also involved in green shipping corridor studies, which are essentially around looking at transporting hydrogen from LA to Singapore and how this can come about. And this essentially looked at hydrogen as a cargo and looked at all the other issues and challenges that it might face. All these projects are essentially carried out at sustainability centers of ABS across strategically located across the globe in Houston, Copenhagen, Athens, Singapore, and Shanghai, where we're taking up projects not only on hydrogen, but also ammonia and working with industry partners on how we can bring about the transition to the hydrogen economy. That's pretty much it from my end. Thank you so much, everyone, for your time. Thank you.
Thank you so much, Achal. With this, I would next like to invite Mr. Saswata Chaudhury from TERI.
Good afternoon. First, I want to thank Chair of the sessions, Mandira and Rajesh. And I also want to thank the organizers for giving me the opportunity to present the study. So this is exploring the role of cross-border electricity trade in regional decarbonization. All of you know that climate change and global warming is a major threat for the entire global economy. All countries, more or less, are having the problems, and all the countries are adopting decarbonization strategy at their national end. Decarbonization broadly can have 5 major components: electrification of end-use activities, renewable generation, energy efficiency in production and consumption, deep decarbonization, which is mostly for the industry sector, where because of high temperature, electrification is not possible, and because of that hard to abate sectors, there are some emissions which can be addressed by carbon utilization and storage technologies. Renewable generation, because of their inherent nature, it varies across time and seasons. However, adding energy storage, be it a pump storage or be it a battery storage, it can address the problem of changing or variation, but it will increase the cost of supply. South Asian countries depends mostly on imported fossil fuels. However, intra-regional trade in fossil fuel in South Asia is very limited because the fossil fuel availability within the domestic boundary in most of these countries are very limited. However, huge amount of cross-border electricity trade, especially within the BBIN, that is Bangladesh, Bhutan, India, and Nepal, has already emerging. There is electricity trade or cross-border electricity trade is beneficial when we greening the power generation. That is the second proposition, that renewable generation, when the source of power generation will be green, then the trade in electricity will be trade in green electricity. And if that will help in effective utilization of renewable energy generation, which is alternative to inclusion of storage. As I already mentioned, that inclusion of storage in the energy system will increase the cost of supply. So it is an alternative measure to address the problem of variation of renewable supply. Help to this cross-border electricity trade, help to reap the economies of scale effect, provide monetary benefits to the exporting country, help importing country to meet demand-supply gap without investment in excess capacity, help importing country to meet its renewable energy target, stabilize grid from variation of RE supply. Successful energy cooperation through electricity trade, there are various examples. As I already mentioned, within the South Asian region, BBIN trade in electricity is already there and it is increasing and huge potential. Other than that, ASEAN electricity trade, there is ASEAN power pool within Laos, Vietnam, Malaysia, Singapore, and many other, mostly all the South Asian and Southeast Asian countries are involved in that. Electricity trade within EU countries, electricity trade of China with its neighbor like Hong Kong, Myanmar, North Korea and all, electricity trade in Latin America, Argentina, Brazil, electricity trade in South African region, electricity trade in West African region. These are some of the successful cross-border electricity trade examples. South Asia electricity energy cooperation is primarily centered around BBIN network. Potential is yet to be materialized with Pakistan and Afghanistan, other than the political challenges. Potential of cross-border electricity trade has been identified, but there is geographical challenge with Sri Lanka and Maldives being the island countries, and there is HD connectivity between through the underseas network. Demand-supply complementarity, Bhutan and Nepal, while surely depends on hydro, India's non-fossil basket are diverse, include solar, wind, hydro, and nuclear. Short and long-term contracts, as well as instant power trading through IEX is already there. Nepal and Bhutan have not only having electricity trade with India through long and short-term contract, but they are also engaged in India energy exchange. However, there are some challenges. There is lack of common protocol, high T&D loss among these countries, and lack of proper infrastructure. These are some of the factors which I already mentioned, that this is the scale of T&D loss among South Asian countries, and this is the primary energy gap among South Asian countries. You see, the scale of T&D loss is very high, around 20% roughly among the major South Asian countries. While the primary energy gap is also huge, it indicates that there is huge potential for energy trade and cross-border electricity trade. So these are some of the facts that fossil fuel dependency of the countries. Bangladesh mostly depends on natural gas, while India's fossil fuel dependency is also higher. Nepal and Bhutan's fossil fuel dependency is a little less in the primary, but in the electricity generation, Nepal and Bhutan's almost 100% of the electricity they generate through hydro, that is green electricity. And those are the growth of electricity demand in recent periods, and it shows that there is huge increase in electricity demand. So as the demand increases, even if you increase the supply, that gap is not reducing. And that was also shown in the previous table. So those are the facts of trade. The left-hand table shows that between the BBIN network trade, Bangladesh is a net importer of electricity from India, while Bhutan and Nepal, while they import as well as export from India. And the right-hand graph shows the scale of export and import of these countries in recent 5 years. And other than that, India has also cross-border electricity trade facility with Myanmar, where Myanmar is also a net exporter. Sorry, net importer. India only exports electricity to Myanmar, like Bangladesh. So those are the complementarity in electricity demand and supply. This helps to identify that there is huge potential. For example, in India, the demand is maximum in the summer season, while during the summer, Nepal and Bhutan has huge and excess supply of hydropower. However, the situation completely changes in the winter. Since Nepal and Bhutan depends on hydro, so in the winter, the source of hydro generation becomes frozen and they fail to generate sufficient electricity to meet their internal demand. In that case, in the winter season, India has relatively lower demand and relatively higher availability. And in that season, in the winter, that is December, January, November, February, in this season, India is able to export to Nepal and Bhutan, while in the summer and monsoon season, India imports from Nepal and Bhutan. So those are the potential and availability and of the existing electricity, cross-border electricity trade. Now, in this study, we try to estimate the economic benefits of cross-border electricity trade. Those are the basic assumptions. Cross-border electricity is preferably in green electricity. The trade in electricity is somewhat similar in nature with traditional trade in fossil fuel. While the similarity is continuous or regular interval trade, the difference is that cannot be stored for a long time like other fossil fuel and need specific infrastructure for execution of trade. Our approach was that we used GTAP, Global Trade Analysis Policy Model, with GTAP database. Impact of regional integration in our renewable electricity trade is measured by welfare and GDP. Regional and bilateral integration, we measured two alternative options. One is export of green electricity increases by 5, 10 or 20%, and export of electricity along with technology upgradation in the source or exporting country. Those are the results of increase in electricity trade from Bhutan to Nepal. That is, Bhutan is exporting electricity to India. This is without any technology improvement in the exporting or importing country. So when there is 5% increase in the existing electricity trade from Bhutan to India, those are the change in welfare and GDP, which is measured in million USD. As the scale of trade is increasing, the benefit of economic benefit both in welfare and GDP is increasing. Next table shows the same thing with technology improvement in Bhutan. So if we assume that Bhutan is exporting, but there is capacity. So unless Bhutan improves its efficiency in production and supply, there can be a time where Bhutan will struggle with its exporting. There will be not much exportable electricity. So we assume in this case that there will be technology improvement in Bhutan, so it will enable Bhutan to continuously increase its electricity to India. So these are the results, and if you compare this with the previous table, you will show the scale of impact has significantly increased both in welfare and GDP. This is the trajectory of, here we measured both GDP and in the first case, this is only electricity trade, and that is complemented by technology improvement in exporting country, here Bhutan. You saw that it is clearly shows that the scale of benefit has increased for both exporting and importing country. Both level and scale of benefit is higher in case of trade cooperation backed by technology improvement in the exporting country. The trade cooperation being futuristic, this trajectory will help to explore extent of benefit from various level of trade cooperation. These are the table where we are going from bilateral to trilateral to multilateral. This BH to I means Bhutan is exporter and India is importer. I to BH means India is exporter and Bhutan is importer. And similarly, India to Bangladesh, India to Nepal, Nepal to Bangladesh, Bhutan to Bangladesh. There is not existing Nepal to Bhutan or Nepal to Bangladesh trade, but Bangladesh has already signed MOU with Nepal and Bhutan to import electricity using Indian territory. So there is potential that in future, Bhutan and Nepal will be able to export electricity not only to India, but using Indian territory, exporting to Bangladesh, which will be benefited all the countries. And this tripartite electricity trade between Bhutan, India, and Nepal, and the final is the BBIN network. So here, not only the participating countries are benefited, but there is also an effect for the other countries in the regions. All are benefited. And it shows, if we compare the first, second, and third table, it shows that regional integration is more beneficial than bilateral cooperation. Regional net gain is higher, individual country benefits are higher, and more countries get the benefit. So major findings of our study was bilateral cross-border electricity trade leads to GDP as well as welfare gain in both trading partners. Benefit is higher when CBET is backed by technology improvement in the exporting country. Regional CBET is with multiplayer partner is more beneficial rather than bilateral or trilateral trade. In spite of negligible intra-regional energy trade in past, there is huge potential for cross-border electricity trade within South Asia. Intra-regional and inter-regional cross-border electricity trade is very important to ensure inclusive growth in individual countries and meet increasing energy demand with sustainable and affordable way. Bilateral network for CBET is already in place for India with Bangladesh, Bhutan, Nepal, and along with Myanmar. And also here we need to inform that India's One Sun, One World, One Grid, OSWAG initiative, India is not only planning to export electricity or having cross-border electricity trade, not only within this BBI network, but to extend its energy cooperation to Far East through Myanmar and Thailand, and to Far West till Oman to the west. And our final slides shows that energy trade and cooperation is important for economic growth and development. Cross-border electricity trade has potential to strengthen decarbonization measures. It helps both exporting and importing countries benefit at national and regional level. So when you are focusing on renewable generation at the national level, you will be only benefited. But if you export green electricity to your neighboring country, the neighboring country will be also benefited. Their target for renewable can be addressed through importing renewable electricity. Scale of benefit depends on nature of economy and trade volumes. Multilateral or regional cooperation is more beneficial. South Asian energy cooperation needs to strengthen BBIN network and include other South Asian countries. Extend cooperation beyond South Asia to Southeast Asia and East Asia, or even to extend to West Asia through OSWAG initiative of Indian government. Meeting decarbonization target at national level difficult for most countries due to limited resources. Meeting regional decarbonization target through regional energy cooperation is relatively easier and beneficial. Thank you.
Thank you so much, Saswata. I think we started off with hydrogen, one of the key new sources of energy. Then Saswata presented to us on electricity trade. Two key points that Saswata touched base was on collaboration and decarbonization measures. Very, very important topics, obviously. I think we should go ahead with the gas trade now.
Sure thing, Mandira. Let's invite Mr. Rajesh Mediratta from Indian Gas Exchange, MD and CEO.
Thank you, Mandira and Rajesh ji, and thanks organizers for this opportunity. Now, my topic is again going back to hydrocarbon. Mandira was trying to move away from hydrocarbon, but we have moved back to hydrocarbon. Now, today's topic I would like to cover that what we should do to see that the gas markets are better. They are able to provide incentives to people, and they should give the price forecast for maybe forward curve for gas prices, and also it should become a really well-functioning market. Since we are operating at exchange, I will talk about it. Just I will briefly touch upon where are we now in terms of gas markets? We are operating a gas exchange, and the exchanges always give you the signals to the market that whether there are issues in the market, there are issues in the gas demand and supply, there are issues in the network, there are issues in regulatory and policy side. So all of that gets reflected in the exchange, and that is what we have done. We started this exchange in 2020, and we have been now more than 3 years we have been operating. Now, just basically, I'll give a brief on what exchange model we have. Today, we have a model of exchange where we do physical trades. So, physical trade is like when you trade on the exchange, it's not paper trade. It's basically you get delivery taken care through exchange. We also take care of the financial settlement. So, all of this is provided by the exchange. And the model adopted by exchange for us is like we provide you option for all buyers and sellers in the country. Whoever is connected to pipeline, they can place their bids and offers at particular delivery points. So we have identified few delivery points. Those they can choose which delivery point they want to buy or sell. Then on the sell, we have also a flexible contract. So you can buy or sell for a day, you can buy or sell for a week, or a fortnight, or for a month. So we are currently providing the trades up to 6 months. And then we also have very special contracts for power and fertilizer that we launched recently. And the new things what we are going to have in future is, one is that we will also be trading LNG. Small scale LNG. Second will be long duration contracts. So today we are doing contracts up to 6 months. We propose to do it for 1 year, up to 1 year. And then we also be trading the green gas certificates or CBG certificates. And then this is the brief of what we have seen so far in terms of markets of exchange. So we have traded about 24.4 BCM of gas have been traded on the exchange, and the volumes being traded is about average is about 3 to 4 mmCMD. If you compare it with the overall volume of the gas consumption we have in India is about 160 mmCMD. Out of that, 3 mmCMD is traded through exchange, and it is good for a new exchange which is only 3-year-old. Normally it takes much more time for getting to this level, and we have seen the experience in other parts of the world. We have, so in last year we traded about 4.9 million MMBTU, which is about 16% higher. Before that, actually we did a good trade. The jump was almost 4 times. So from first year to second year we did 4 times. Then from second year to third year we have seen the growth about 16%. And the total number of participants on the exchange is about 200 plus. So most of the gas entities are today participating, and this is the whole year calendar. Like every day we do trades. There are sometimes we do small trades and bigger trades. So you see the spikes. That shows that we have done larger trades. And this is the price and volume which for delivery. So whatever delivery we are undertaking after doing trade can be for this month, trade can be for next month, but finally the way it is delivery happens, this shows the delivery part, that how much delivery has happened in each month and what is the price of average price for that particular month. And this is comparison with the international benchmarks. So our prices being discovered is very aligned with the international prices. Only thing is there is some discount when price in last year was very high in November and December, was going up to say $30-40. Today and even that time our prices was much lower, but otherwise when prices are around $11 to $15, our exchange price is coming out to be very close to $10-11. So there is some discount to international prices what we have seen so far. Now, what I wanted to drive that when you create a good exchange, what it means that when you make an exchange, have good volumes, good diversity, you get a lot of benefits. The whole market gets benefit, the whole sector gets benefit. One is that when you have a large number of people, large volumes on the exchange, the price discovery is very efficient. This is very competitive, and it attracts market participants because people get confidence that, okay, market is discovering a price based on lot of buyers and sellers, and there should be many types of sellers with different variety of gas with them, and there should be different buyers also with different types of demand and capability to pay for that. So for that reason, we see that if there are more number of people joining, more volumes coming. So today what we are doing is about 2% of trade of the country. If suppose it grows to 10%, then all of the benefit which we have listed here, basically that will be received by the market participant. So, so one is that it will enhance the market confidence. Second is the prices being discovered on the exchange will give you confidence that whether you can rely on the exchange. If you want to buy something at a very short notice, can you buy that? If you want to sell something at a short notice for different times of the day, different periods of the year, so all of that actually makes people rely more on the market, and then market discovers a better price and more competitive price. So when you want to see that how the markets can grow, how we can create a better functioning market, so basically the enablers for that market is that one is that you should have infrastructure. That is anyway primary requirement. But beyond that, three more pillars which we have identified. One is that what we need to do so that there is a supply side diversity is created. Second is that how we should see the demand side, whether all types of buyers are coming. If they are not, then what we can do for them to come on the market. Third one is that what we should do in terms of regulatory and policy. Because basically the purpose of creating a exchange is that you create ease of doing trade, and then people should find least barriers in coming to the exchange and do the trade. So I'll just go through each one. One is that infrastructure. I don't talk about it because anyway we have good infrastructure in terms of network. Of course, we are going to add more network, and we are going to add more of terminals, import terminals. We may be adding storage later. So these are basically parts of infrastructure. These things we are going to do, and we will have something much better infrastructure in next 2 to 3 years. But what we are not doing are these on the supply side. Few things are identified. On demand side, we have identified few things, and then on the policy and regulatory intervention. So one is that on the supply side, not all gas is now coming on the exchange, because there is we have like total out of total consumption. Here what we are saying that 55% of that is coming from the domestic gas, and 45% is coming from the imports. Now out of 55% imports, 60% is regulated, like the price is being set by the government, and you cannot actually do trade of that gas. 40% has got some pricing freedom, but that also is mostly sold through long term. So that also doesn't come to the exchange, but maybe 5-10% can come to the exchange. So I've taken 4% there. And then we have taken this imported LNG. There around 80% is long term and 20% spot. So actually out of total India's supply, we only have 12% which is freely available for spot markets. So we need to do something to enhance that percentage. And for that, we are suggesting that why not we should have a mandate for all the domestic producers to sell at least 10% on the exchange, so that they have a different cost structure. LNG imports are having different cost structure. So when all of this will come to the exchange, the pricing discovered will be more of Indian price, will be much milder, and will be suitable for the buyer. And this is will also give a good price, will help to discover a better price for the market. On the spot market side, of course, it's a market. There's complete freedom, so there's not much to be done. So basically, what we are saying that there should be no price cap. There should not be any restriction on the price marketing, the pricing freedom gas, which is mostly coming from reliance on ONGC. Similar kind of mandates have already been given in most of the countries in Europe, where they started exchange. They wanted to create a better gas hub and liquid exchange. And then if you see, almost every country like UK, Spain, France, every country has actually mandated certain part of their total consumption to come on the exchange, so that there is a better price discovery and people rely more on the exchange to source their gas. And these mandates were not only for 1 or 2, they were almost like 3 to 4 years. And few mandates were very high, like 15-20% of mandate was also there in many countries. In many countries, the number were more on 4 to 5 billion cubic meter per year. So this talked about it, that domestic gas, we should have one is that today there is a cap of 10% on HPST or ceiling price gas, that they can sell only 10%, up to 10% on the exchange, that cap to be removed. And second part is that there should be strategic mandate to sell at least 10% on the exchange without any price restriction or resale restriction. Coming on the buy side, what we have seen, that we have mostly 5 segments for gas sector. Fertilizer is the key, which is 30%. Then we have power, we have refinery and petrochemical, then CGD, and then there are other industries. Now, if you see out of total consumption of fertilizer, which is about 30%, nothing comes on the exchange. So they cannot source anything on the exchange. So that's one limitation. Of course, so recently, last week only, there was an order issued by Fertilizer Department which allowed sale of buy of gas through exchange. That can give some kind, that is one step towards making it a better thing. But there is a lot of thing to be done. Because whole of the fertilizer sector can consume much larger from the exchange, because it is cheaper, not because it is what we should mandate, but otherwise also it is cheaper, so that is, it makes sense. On power side, we see that there will be there is a need to change regulation because today power sector needs gas on a very short notice, but regulation doesn't allow that. So that change in regulation is required to see that we are able to get a better gas can be purchased by the gas power plant at a very short notice. And there are a few other things also, but they are not major ones. But major absence of power and fertilizer is also one of the area which we need to address. Demand side, I talked about gas. We can also talk about CGD network. We feel that today industries which are connected within the CGD network, they are not able to access third party if they have demand of less than 50,000 cubic meter per day. Now, there is a provision that after CGD exclusivity is over, then they will be allowed. But so far, none of CGD exclusivity has happened. So that needs to be done at the earliest, because the time has expired to make them free long time back. Now I think it is time that we should see that this should happen. Now there are several regulatory and policy interventions which we feel, and they are subject by itself. I will not dwell upon it. My time is over. So basically we are saying that there should be more transparency. When somebody wants to do trade, we should provide network capacity on real-time basis, so that he can decide whether he wants to, he can buy gas or not. We need to separate the transport and marketing functions of our bundled entities like GAIL and GSPC. Of course, we cannot do it immediately, but there is a provision of affiliate code of conduct that can be, for that already there is a regulation. Only thing is that needs to be activated. Third one is transport contracts can be standardized. Fourth one is unbundling of transport and marketing. Of course, that is a longer term. So before that, we are saying that affiliate code and electronic bulletin boards can be implemented. Then we need to create a gas system operator which will be independent. Then we need to make our transport tariff, which is based on entry-exit. This is the subject by itself. Then we also need to do, what we need to do is that we have to make our imbalance system linked to market. That is what almost all European countries have done. And then most important and most verbally spoken by all the sector participants is GST. So since VAT is creating a lot of hurdles in doing trade, so it is better that we have a common GST, and common GST will also provide a way to do multiple trades. Today churn rate of our gas trade is only 1 or 2, but most of the matured markets have got churn of maybe 20, 30, 40 and 90. Now that churn can only happen when we have a common GST and there is an input credit available. Otherwise, there is a pancaking of taxes happen, and because of that, people are not able to do multiple trades, even though the cheaper gas is available. But just because there is a 15% tax over and above that, people are not able to do trade. So this is all. I will rest my presentation now. These slides are there. Of course, they will be shared, and you may go through it. Thank you.
Thank you, Rajesh. Now I would like to invite Abhinav Goyal from Rystad.
Thank you, Rajesh, for the introduction and for inviting me to the stage. So, ladies and gentlemen, esteemed guests and organizers of the event, I would like to extend my gratitude for providing me with this opportunity to express my views and insights on carbon taxes, along with where India stands at present. I would also like to thank my organization, Rystad Energy, for trusting me on delivering on the same. I am Abhinav Goyal, and I am an upstream analyst and team lead for the South Asia region at Rystad Energy. Over the next 15 minutes of my presentation, I look forward to discussing innovative perspectives from an upstream standpoint that can propel India towards a better and sustainable future. During the course of this presentation, we will be looking at the global upstream carbon taxes, India's current upstream scenario, India's energy consumption, emissions forecast, our evolving energy mix, and also India's plans on carbon trading under the cap and trade scheme. Moving on to the first topic of global carbon taxes in the E&P sector, let me first introduce you all to the concept of carbon pricing. Essentially, carbon pricing entails a government-set fee that is charged to the emitters for each ton of greenhouse emissions that they produce. It can also be viewed as a price that the companies pay for polluting the environment or the cost to environment because of certain polluting activities based on the carbon content of the produced hydrocarbons. Please note that this heat map includes countries with marginal hydrocarbon production as well. As can be seen very clearly, the coverage across EU for carbon tax rates is unmatched. EU leads the way for carbon taxes, setting an example for the world, especially for regions like Middle East and Asia, which are currently on the back foot when it comes to upstream carbon taxes. Now we look at how these carbon taxes have evolved in different countries across varying regions. Norway led the way by implementing carbon taxes way back in 1991. Most of the other countries that have implemented these carbon taxes have only done so in the later half of the previous decade. The taxing scheme broadly remains the same across regions, varying with type of fossil fuel and carbon content. However, there are some additional province-level taxes that may be applicable to countries like Canada. In general, incentives and exemptions vary based on reductions in emissions and for diversification of portfolios into greener technologies. The underlying aim is not only to push for reduced emissions, but to also use the revenue generated using these carbon taxes to fund environmental and climate-related projects and initiatives. Here we have an impact analysis using an average-sized oil field to quantify the impact that carbon taxes have on the net government take. As can be seen, EU again leads the impact, with Norway leading the way with an increase of more than 4% on the final government take, Canada too has a high impact of almost 4%. However, countries in Latin America have a very low impact, varying between 0.1 to 0.3%. This is driven by the high carbon tax rates applied in the EU as compared to very low tax rates in Latin America. Further, this is driven by stringent laws and regulations in EU. Let us now understand where India's upstream sector is headed. Recent news of first oil from ONGC's flagship project in the KG Basin, along with the two new discoveries in Mahanadi region, namely the Konark and Utkal, have set the tone for the years leading to the next decade. There will be an imminent push, as can be seen, towards the offshore segment, with KG Basin leading the growth in domestic production. Since a number of Indian mature fields either have or will be entering their mature and declining phases. Sanctioning activity in the offshore segment is expected to increase in the coming years, adding a total of about 3,900 million barrels of oil equivalents as compared to 2,300 million barrels of oil equivalents in the onshore segment, thus clearly depicting a push towards the offshore segment. The sanctioning activity in the region is also set to increase. However, if we look at the onshore segment, the sanctioning activity has remained more or less flattish in the recent years, which too is expected to pick up somewhat in the coming years. The underlying aim is to ramp up domestic production in a bid to reduce our import bill and thus bolster the country's energy security. Over the past 60 years, India has witnessed some varying fiscal regimes when it comes to the upstream sector, starting with the nomination era, after which came the pre-NELP regime, the NELP regime characterized by the PSCs, and now finally the HELP regime, which is characterized by the latest running RSCs, or the revenue sharing contracts. In recent years, India has been working on trying to generate foreign interest in the country's upstream sector, and to rake in FDIs. In a bid to do so, the fiscal terms have been under continuous scrutiny, with an aim to make the terms fiscally attractive to investors and operating companies. As can be seen, a number of changes have been introduced over time when we compare the nomination regime to the current HELP regime, some of which include changes such as reduction in oil and gas royalties, removal of oil development cess, and introduction of the latest revenue sharing mechanism with a capping of 50% at the high revenue point. The impact of this can be seen in the chart alongside the table, showing an accompanying fall in the government takes and a subsequent increase in the IRR, or the internal rate of return. Even though their impact is yet to be realized from an FDI perspective, the terms have nevertheless been made much more attractive as compared to what they were in the budding stages of the country's upstream sector. Let us now look at how India's energy consumption and energy mix is expected to pan out till the midst of this century. India's power consumption is set to increase by more than 80% as compared to 2023 levels. The consumption from the residential and commercial sectors are expected to remain somewhat flattish, with an increase in consumption by about 40% in the industrial sector. A huge growth is also anticipated in the transport sector towards the end of the decade, which is driven by the penetration of EVs in the Indian market. However, this increase in power consumption is accompanied by a subsequent reduction in GHG emissions from power plants, falling by more than 50% in 2050 as compared to the 2023 levels, simply because of a shift to greener energy sources. On evaluating the energy mix, on evaluating the energy mix for the coming years, it is evident that even though our energy consumption is set to increase, the share of renewables and nuclear will continue to grow, touching over 80% of the total energy share by 2050. However, fossil fuels cannot be discounted from the equation, since they will continue to play a major role till the end of the next decade, which leads us to the final part of my presentation. Now let us look at what India has in mind on the recently announced CCTS. We will also be looking at some scenarios of varying carbon tax rates in the upstream sector and the impact they could have on the net government take. As can be seen in the heat map, India's upstream emission intensity lies in the median range when compared to the top 40 producing countries. Please note that this heat map includes countries which have been producing for more than 5 years. Even though India imports most of its fossil fuel requirements, we have already established that fossil fuels are going to play a significant role till the end of the next decade. And thus, it is important to understand where our energy mix is headed. Sorry. This makes it imperative to introduce carbon taxes on the upstream sector as well. In line with India's long-term net zero targets for 2070 and short-term targets for sustainability, India plans on setting up a domestic CCTS or a carbon credit trading system very similar to the EU ETS, which is also known as a European Union emission trading system. Some of the sectors that will be targeted in the beginning in India include power, fertilizers, petrochemicals, cement, steel and iron, and also the paper and pulp industry. All of these industries are energy intensive and would essentially cover more than 70% of the total emissions. However, no targets are yet being set for the upstream sector in particular. Thus, we have created a scenario where carbon tax rates are applied to India's upstream sector at different price points, and their impact has been analyzed in terms of the net valuation at an asset level. The same can be scaled up for a project or company to reflect the same. Using the country's general tax model of the nomination era as a reference, for an average oil field, it can be seen that carbon prices varying from $20 to $65 per ton. The subsequent increase in government take is between 2 and 10%, which is slightly under 10% to state the facts correctly, with a subsequent fall in the net valuation, since the carbon prices would be an additional cost that will be incurred by the operator. Finally, we can conclude that India's upstream sector is poised for growth, with strategic emphasis on offshore exploration and production. Recent developments such as the first oil from ONGC's KG Basin and the 2 discoveries signal a lot of optimism. India's energy consumption is projected to surge, driven by industrial growth and increasing transportation demands. India's energy mix highlights a gradual shift towards renewable sources. However, fossil fuels remain integral to the energy landscape. The recently announced CCTS reflects proactive measures taken by the Indian government to align with the global sustainability goals. As with the EU ETS, India's proposed CCTS too will have to cater to and factor in sectoral nuances and refine the CCTS framework with time to help develop an effective carbon trading mechanism. Issues such as those of over-allocation of allowances to certain industries along with price volatilities will also be some factors that will need to be adjusted for in the coming years. That concludes my presentation. Thank you.
So I guess we had lined up an interesting set of presentations, covering the transition fuels like hydrogen and the clean fuels like RE, and then moving on to the gas, because gas is an essential transition fuel, where Mr. Mediratta talked about that what are the great enablers that the gas exchange is providing in terms of transparency, in terms of increasing the depth. But at the same time, there are demand and supply side imperatives that should be put into place. And lastly, Abhinav talked about that rightfully fossil fuels are going to play the role in the near future, in the long-term future. But at the same time, with the carbon taxes coming into picture, definitely, there would be a premium that would be placed into the existing fossil fuel system, which is going to make the alternate fuel sources more and more feasible. So I believe, we don't have time for questions. Probably, we have to close now.
Yeah, I think so. But please feel free to reach out to the speakers if you have any questions after the session. Thank you.
Thank you.